So what I'm going to do is I'm going to start with a very long-term chart that I've shown a couple times before, and that is that's the Dow 100-year chart with a really amazing quarterly cycle on there that goes for 7 years on average. That's 7 quarters on that's 7 years is 28 quarters on average, and as I showed last time, that calls for a significantly lower market to come into mid-late 22 or even getting into the beginning of 23. Some of the monthly patterns show much more mid to late 22. So still, there's a lot in these longer term trends that are going to be pushing down. I'm going to show you this 100-year chart as we start, and we'll go way back to the Great Depression and see this chart right here. So I'm gonna take you through most of this 100 years, just so you can get an idea. What I want you to see is the money flows. These are really the most dominant money flows that our analysis shows us, and the recurring pattern, which occurs as you see here, average 28 quarters, a 7-year cycle, is just astounding. It bullseyes a lot of the bear market lows, and when we get up into the more recent times, you'll see just how close it lined up. Here you could see it. This is the cycle bracket right over here, and that cycle bracket is set at 28 quarters. And you could see this is the crash of 29 right over here. That came after the roaring 20s. Stock market gained 600%, and there was amazingly cheap credit and huge technological expansion at the time, mass production of goods, the electrification of America. All of that brought this move up from what was the forgotten depression in 2021 all the way up through the roaring 20s here and the crash that we had in 2029. So you could see this vertical line right over here, and this depression, the recession, is the gray area. That made the bottom. Now when you look 7 years later over here, the crash of 37 came out shorter. You can see that comes to be a little bit shorter cycle, but then the decline right over here that occurred after World War I, after this huge stimulus spending, that pretty much gets right on line, as you can see right there. So this was 7 year, this was about 6 year, this was 7 year, and here's the post-war boom right over here, and the break that came into 1953. And that you can see that low is just a couple of quarters late in here, but again, we're averaging 28 quarters as we look. Now we're going to move this forward, and I really want you to see that this is really the most dominant forces that we look at in the market. As we look over here, we see this is the cycle right in here. There was a break in 60. It came down and took the lows out by a little bit there in 62. Here's the low here in 66. Here's the low right over here in 74. And of course, this is the energy crisis. So you can see the cyclical patterns right in here, as each of those averaged about 7 years. Note the note right over there. Way back here in 1974, I became a member of the CBOE, May 20th, 1974. And I traded at that time the very end of that bear market and the beginning of the next bull market. Yes, right in here was a challenging time. As a matter of fact, it took me 10 months to turn it around and to be profitable when I first got on the floor. So here's that next line right over here. Remember, the gray areas are the recession. You could see this break right over here that took you into 1981, 82 right there. And there is that next cycle. You can see that very clearly. Interestingly, the crash of 87, as we get right over here, is a bullseye on these cycles right there. So I'm just going to grab this right over here, and let's just look at these right over here. So you had the great bond market massacre right over here in 94. That was actually not a big decline over here. It was a big decline in the bond market, but you could see the crash of 87 right on line on this 7-year cycle, this one in here a little bit early. So now we're going to advance over to present time and bring this right in right here. And you can see these last several cycles right in here. As we look at present time right over here, here is the great tech bubble. There was a crisis right there, long-term capital, if you remember. Here's the tech bubble and the dot-com bust and the recession. Here's that 7-year cycle. Here's the 7-year cycle. Here's the 7-year cycle right at the bottom. You can see 28 quarters from the Greenspan bubble and the great financial crisis. You can see that. So it was a beautiful cyclical pattern. The next one over here was the mini bear right over there. That was the Bernanke-Yellen bubble. And then this pullback over here, depends on what indexes you were looking at. It was like 17 to 23% decline right in here. And then right over here is Powell's, it's really the Yellen Powell, or Powell COVID-19 debt everything bubble. And the Fed, right over here, you can see that's where they tried to raise rates, where you got that dip. And here is the COVID crisis there. But the cycle bottom was over here. When you look at that way back in 2015. And here, between these two vertical lines, is where the next cycle bottom is. What that says, just as happened right in here, and in here, and in here, that this time frame in here should have the next corrective period in this 7-year average cycle. So it's 28 quarters on average, but the average bear market, the corrective phase, is 4.4 quarters, going back this whole time of the almost 100 years of time that we looked at. 4.4 quarters of decline after the bear market is made. You can see in here these were longer right in here. This was more like about 6 quarters. This one here was almost 2 years, or 2 years right there. This one was only about 2.5 quarters. And right over here, you could see the market is topping. And what's coming up as we look at this is the great COVID-19 reset. So that is an amazing time there that we're pointing at, because it's a time when COVID is flaring up right now, and it'll probably be in much better shape during that period. The Fed is pulling the punch bowl, is essentially what's happening, and the market between the COVID and the Fed and the Biden's whole plan for their BBB, all of that is pulled or stalled at least. That means that the forces that were pushing the market up through the whole time are going to be not there anymore. Now you can see where these levels are in the and the Dow Jones Industrial Average. That way up there, which is a very optimistic level, is 31,720. A 20% bear right over here is 29,200 approximately. That is, in my opinion, an optimistic place to expect the market to stop. So, well, let's just say it's a 20% bear, and that would be 29,150. There's another support there at 28,500 or 600 right at that point. So you can see that would be a very optimistic area to expect the bear market to end. And this is a very wide area that takes up almost 2 years of time, or a year and a half of time. So the earliest point we have for the low is summer of 22. And it could go way out over here and have a much worse bear market that takes you out into late 23 or 24. So that is very possible based on the timing that we see in here. So, while, we've been talking about a decline, and I'll show you into the summer of 22, that could only be the start of this corrective process that we're talking about in here. And you can see these cycles, they are just amazingly consistent, as each of those cycles averaged 7 years, 28 quarters, and we have yet to go into that corrective process for this cycle, and we're just in a very unusual time anyway, because no time in history have we had the interest rates as low as they are right now and a situation where the Fed is set up to raise interest rates. So we could get a flat yield curve with 10-year yields at 2.5% or even 2%, and that would be a historic situation. And it just shows the overall weakness that is in the market that was created by all this Fed activity. So what we're looking at when we look at that quarterly cycle is that there's a pretty good likelihood that the next couple of years are going to be difficult for the stock market. Now, I'm going to move from this chart right over here, which is the quarterly chart, and I'm going to start looking at the monthly patterns because these are very important. Well, that's the weekly pattern, so we're going to move over to the monthly pattern right over here. So let me bring this in for you to see. And these are the monthly cycles, and you can see in here that they're also just amazingly consistent when we look at this. I did this a little different because anytime these are the cycle brackets which show you the dominant and the intermediate and minor cycles. Whenever there are 3 cycles that are nesting, I put in 3 stars, as you could see. When there are two nesting, I put in 2 stars. So that's the way I'm showing the bottom in here. And here are the 3 stars of the next low that's due. Here was the 2002 peak and the bear market from the dot-com bust. Here was the 2007 peak and the bear market from the great financial crisis. Here was the mini bear right over here, and I showed you all of these on that quarterly chart for the 7-year cycles. And now we're coming into this period right over here. And that is a period that, and again, I want you to note the harmonics in here. We're looking at 20, 40, and 80 months in these harmonics. And this is where the next low comes right over here in the timing range for that low. So that comes out to somewhere between May and July right there. And you'll note that I said that it could go a lot longer, the bear market could go a lot longer into the next decade. And this cycle right over here, the next giant one that you can see right there, takes you way out into 2028. So I'm not saying we're going to have a bear market way out till 2028, but that's where that next dominant cycle bottoms out over there. So that is something that, well, I hope I'm here talking to you about in about 5 or 7 years. So the pattern that we see right now is that this is a period of risk right in here. And the fact that the market is acting so poorly right now on these monthly charts, and you can see these 2 high waves, this is barely even a downtick when you look at that. I mean, it's just starting right now. And there is devastation in a lot of categories and a lot of different stock sectors. But the indexes have just begun to fall. And those stocks that have been heavyweights in the indexes, well, I showed a chart back in Market Week that said that the strongest stocks historically are the ones that turn into the laggards in the next year. And that's the ones that become the highest cap stocks. And there's just too much money that's in those. And in this case, they are the ones that are the index, heavy weighted in the index stocks. And the indexes are very likely to pull down sharply. The best case right over here that I can make out into this summertime period right there is about 37.53 on the S&P 500. That would only be a 20% bear, and getting down over here to the 25% bear and that 50% fib from this move is a reasonable 3,500 right in there. That to me is reasonable over this next 6-month period. So we're looking for a decline to come of some significance right in here. And I'll show you when I look at the intermediate and shorter term patterns that the likelihood is pretty good that it has begun, because there are some breakdowns going on right now. I'm going to look at the Nasdaq so you get a sense for this also. NDX. And you can see in here the same patterns. I have the Great Experiment listed on the bottom. And right over here, the same decline that is due, the nesting right in here that takes you into the summertime. And the same harmonics that we see right in here. The low right there, spot on, the low here spot on, and the low that's due out over here. So there should be a significant decline right in there, a real bear market. And real bear markets are, 20% plus, but the average bear market is about 33%. And as I showed in the monthly on the quarterly chart, that's average corrective phases last 4.4 quarters. So this could go well into the late period in 2022 before this is over with. Now, this is drawn like it goes straight down, but of course there can be a lot of chop in here, and markets don't tend to give up that easily, especially when momentum is very strong. So I'm going to move this chart out, and I'm going to move another chart in which looks at the S&P 500 and looks at the momentum conditions. Let me just get this in here. And this is the same chart essentially, but let's just look at this market right over here from 2002 out to 2009. And you can see the momentum conditions that were in here. This is the slim ribbon. It turned positive here. This turned green. The slim ribbon PO on this monthly chart, giving all of this positive conditions right there. Eventually what happened is it neutralized right here. And you can note in here that the reversal scout started to come down, and then it was red. And while it was red is when the biggest declines went on. That's typically what you see. So that's that bear market right over there. Now the market, when we look from this last low over here, we're still in a period of very good strength. So on this monthly chart, you could see momentum very strong on the reversal scout, very strong on the slim ribbon. And this is what pushed the stock market up all year long. The momentum that came from the longer term patterns. Of course, the quarterly was positive also. And until this gives us a signal and begins to turn over, it's not likely that there's going to be any significant decline. Now, it's gotten a long way from the above the slim ribbon, and it tends to keep coming down through it, as you can see. So if it came down just below that 21-month and this turned down, well, maybe it only falls 20%. It's possible that would happen. But still, this same bear market is due, but the momentum, you can see, is powerful still on the upside.